Okay. All right. Welcome, everybody. I'm Jim Kenney, content provider at OptionProfessor.com, and I'll be with you for the next hour to give you a little bit of my views, my observations, and my opinions on what I see going on out there in the wide variety of the markets, including the stock market, bond market, the U.S. dollar, crude oil, the metals, and international. So that's a lot to chew on here, and I will get into it momentarily. Before I start, a little background on myself. I'm a graduate of Boston College, and I've been in the investment arena here for many decades. I've done hundreds and hundreds of seminars nationwide, educating thousands and thousands of people on the uses and risks of options. So that has been my forte throughout my career. Today, I'm going to be giving you information that I see. And obviously, I'll give you things that I think are areas to look into. But again, as far as specific recommendations, that won't be happening because obviously I don't know any of you, and giving you recommendations with the blindfold on is not my game. So what I will be doing right now is giving you a little input on what I'm seeing. This week, what did we see? We saw the Fed cut interest rates, widely advertised, quarter of a point, no surprise. But we also saw them have to pony up billions of dollars to rescue the overnight markets via the repurchase agreements. And liquidity dried up. The Fed funds almost hit 10%. Not only did they have to do it one time, they had to do it the next day, 75 billion, and now they plan on doing it all the time. Is it a big deal? Well, when the liquidity dries up like that, obviously it's a big deal. Is it going to be problematic? Only time will tell. But that definitely was a big thing that happened this week. What did the Fed say? We had no preset limits. Obviously, it looks like they're ready to ease if things turn bad. But also, they're not going to just ease for the sake of easing. So obviously, there's not much to read into what their statement is because they're going to be looking at the data like we are. And if the data turns one way or the other, that's the way the policy is going to go. That sounds a little bit short-term thinking, but again, I think between the president and others on the panel, like that Bullard, I guess his name is, James Bullard, there's some people who want to go a little nutty with the machete on interest rates. Again, I don't know why they'd be looking at Asia and Europe as a model. Both countries have very low growth, like in Japan, and their deficits are ridiculous. And there's a reason why they don't have a currency that everyone uses to settle trade. And then, of course, in Europe, look at their banks. Their banks are, in single digits. You could shout at zero from some of the bigger banks like Societe Generale and Deutsche Bank. So, like some people say, just because people are jumping off the George Washington Bridge doesn't mean you should be doing it as well. With regards to other things, the Bank of England remains steady on their interest rates. And of course, Bank of Japan, no surprise, they're ready to add stimulus every time they get out of bed. QE is back in the talk now because they would, I think, prefer to expand their balance sheet than to go to zero interest rates. I think that was the vibe I got out of Powell this week. Next week, this week coming up, you've got lots of Fed speaking going on. You got some GDP information coming out, and you've also got durable goods, home sales, and personal income on the docket. So there is stuff coming up. Hey, listen, I've been around a long time. You should be keeping your eye on the ball, and you know what the ball is? Earnings, and you know where they're coming out next month. And do you think this market with this complacency is ready for any kind of earnings surprises? Well, why don't you ask the people who own FedEx? Because obviously they weren't very prepared, and they got whacked extremely hard. Now, is that a precursor to others announcing bad stuff? Not necessarily. What is everybody saying? That it's a specific situation to FedEx and it's not rampant in the market. How do they know that? I don't know. I don't think they do. So again, the big question is are these earnings going to disappoint? And when you're at 3,000 on the S&P and the VIX is under 15 for a while, is this the environment that the market can handle a surprise? And if everybody wants to go out the door, it's going to get pretty crowded going out that door. You still got to leave the door open for a rally because they ran the stops above 29.40, right? There are a lot of stops above 29.40 on the S&P. They're gone. And then the rest of the stops would be above 30.30, which is the obviously all-time high. Will they let those stops alone before and if they take it over? Maybe, but also it wouldn't surprise me if they could try to run it up to 30.50, 30.70, and then roll it over possibly. My view and my base case is that 29.50 to 3100 is a sell zone, and so far I see no evidence to make me change my opinion. If you could take these transports and get them above 11,000, if you get that Russell index above 1600, 1700, then of course you'd have to change your tune, because then the Russell, the small caps, and the transports would be confirming what has not really been confirmed by Apple. We haven't taken out that 233. The Amazon haven't taken out that 2050 area. So it has not been confirmed by a lot. The other big story today, this week, is the big fade in some of the streaming war companies like Roku and Netflix. On Friday, it was D-Day for Roku. We were off $25 on 65 million shares. That's huge volume. And of course, $25 is nothing to sneeze at. But now it's 40% off its highs for September, which is 176. And that 40% correction is one of the Fibonacci number areas. So, you could watch around this 100 number to see if it could get a bounce, but clearly it's on the defensive. And Netflix, same story, off $15 on Friday, and 23 million shares, huge volume, big drop, and the shares are 30% off its 386 highs. So who's the culprit? Obviously, you got Comcast entering the arena, Apple, Telephone, and Disney. And obviously, you've gone from where people were not considering any competition to where the room is starting to get pretty crowded. And the other players in the room certainly have a very big bankroll as well. So again, Roku and Netflix definitely on the defensive because of competition, it looks like. Other things that I saw this week, which before I get into going around the horn as far as the markets are concerned, I did see dividend-paying stocks, high dividend-paying stocks like Telephone and Pfizer and Bristol-Myers and British Petroleum and Royal Dutch, all had some improved action in the last 2 weeks. And they're coming off of lower areas. So again, you get paid a pretty good dividend on those. And of course, you also may have some upside potential if those turns are for real. Also, as far as insider buying, Kinder Morgan and Oxy looks like they had some interesting officials buying into the company with some pretty decent amount of money. And so I'm kind of keeping an eye on those two things as well. They paid good dividends as well. When you get a dividend, you're watching a movie, and if the movie's really good, you get to get a good movie, plus you get paid to watch it with the dividend. If the movie's okay, you still get the dividend coming in. And if the movie turns bad a little bit, the dividend can be used to offset some of the risk to the downside, because obviously you're getting paid a certain percentage on your money in dividend. So that's what makes that somewhat interesting. A couple of small companies in the energy sector, CRK and WPX, are ones that I'm keeping an eye on. One of them had a big investor, Jerry Jones, come in from the Dallas Cowboys, and after he was on Bloomberg talking about why he did it, although he did say it was a long-term investment, in the short term, the stock definitely got a pop. And then also WPX, the PE ratio is very low. It looks very cheap, and there could be some potential there too. So keeping an eye on that is not a bad idea. Okay, so as far as stocks are concerned, again, you've got to be a little concerned, because I look at the VIX every day and have been for decades. That VIX does not seem to like sub 14. And sub 14 is really when the market's in very good shape. Between 10 and 14 on the VIX, you're in a pretty good market, pretty steady, pretty higher. 15 to 20, obviously that's when it's a little more dicey, and you'll probably get some corrections. And of course, if you get above 20 or 25, you got a pretty good shot you're going into the abyss. So the bottom line is right now, we were at 13 and change on Friday, where we got 13.35 was the low on the VIX, and it closed above 15. So again, and the market did definitely go home with its tail between its legs a little bit, because the high of the day was 30.16 on S&P, and it went home at 29.92. So that's the better part of 25 points off the high, something like that. So what am I saying now? Again, you have to respect the upside because we're above 29.40. And you have to respect the upside because the 200 and the 50-day moving averages are still inverted. So obviously, it is premature. There's no evidence of a big turn down, right? So you don't want to get nutty by getting negative on the market. But you also want to respect the fact that, you could be at rarefied air. And if we do break 29.40, that would give me a pretty good feeling that we are at rarefied air. And if the earnings don't come in very well in the month of October, that could be a rough racket. So again, up in the higher neighborhoods, some of the strategies to consider would be ones that reduce your cash risk, right? And so what kind of option strategies could reduce your cash risk? Well, one could be a collar strategy. And a collar strategy involves doing a covered call, right? And then taking the premium and then using it to buy puts underneath. So then you bracket your position, which means you're limiting your upside, but you also have a floor underneath until the options expire. That strategy can be very effective sometimes. Stock something like Boeing when it was at 446. If you sold the out of the money call and bought a put, when it drops down to 340, you've got a parachute. If you don't, you're taking in water and you're taking in a lot of it. With regards to another strategy, if you got a big gain in something, I mean, why be a tightwad about it? If you made 20, 30, 40 bucks on a stock, why not take $3 or $4 or $5 and buy a put? At least you have some insurance on it. Yes, you'll lose the premium if it doesn't drop. And yes, your insurance is only good for the strike price you choose minus the cost of the option. But it's better than having no umbrella if the rain starts coming down. Now, the other thing to do for those who are trying to reduce cash risk and have had a nice big gain is to do a replacement trade. And there you're looking at, say you had a stock, a position that was up 10, 20, 30, $40 or whatever, and you remove that position and you replace it. It's called a replacement trade by buying calls. Now, in that case, what you're doing is you're going to take a limited risk call option, and it'll be X amount of dollars, a fraction of the stock, obviously. And hopefully, if you can, take it out of your profits you've made. And then you're hedging yourself in case we blow off to 3,100 or 3,200 or 3,600 or one of these lovely numbers people are talking about. And then, of course, if it goes in the tank or goes sideways, then obviously you would lose the premium, but that would be the limit of your exposure, the total price of the option. So replacement trades, collars, married puts, those are three things to take a look at if you've got good gains and you think things might quiet down, or you think that the month of October might not have the holiday Halloween in there for no reason, meaning it could get a little scary. Okay, so what else is going on here? Let's see. All right. In the stock market, one thing that I like to do is I like to look at sectors, because the idea there is that rising tides lift all boats. Well, in the stock market, it doesn't lift all boats, but it can lift a lot of boats. And you certainly would prefer to see the sector you're in to be moving in a direction where you're kind of betting, right? So I went through a lot of the sectors using the Vanguard ETFs as kind of a proxy. Obviously, you can use anything you'd like. I'm just saying what I use. And I noticed that some of the sectors are starting to show some signs of life that were a little bit under pressure. And some of them are turning a bit, but they need more price evidence to kind of produce some solid evidence that a turn is going on. So let me give you a little bit of an idea here on a couple of the ones that I'm watching and give you an idea of what I'm seeing here. Let's see if I can go to the screen here and change a couple of these things. Let's start at the ones that look like they're trying to turn, possibly. Now, this first one is energy. Why did it have obviously they bombed the fields, boom, we went way up. Then things looked like they were settling down, and so the prices came back down. All right, so what is it doing now? Well, as long as this oil can stay above 54, in my view, it's still in a constructive state. You take out 54 and 50, and you can stick a fork in the oil as far as I'm concerned. So I'm showing some respect for the turn. And, of course, we had a big turn and a big volume, right? But then the volume dries up on the dip. Well, that's not bearish. You have big volume on the up and then low volume on the pullback. And then, obviously, you'd like it to hold. Well, the ETF we're looking at here is 81 bucks, and the 50-day and the 200-day are at 79 and 84. So that's why I'm saying we really got to get above 84 and stick in order to really get an idea that these moving averages may turn and that maybe there's more to come. The good news about the energy sector is that a lot of the stocks pay darn good dividends. things such as British Petroleum, Royal Dutch, Oxy, CVX, which is Chevron, and then some of the companies are smaller that could get running pretty good if things got hot. So again, I'm always interested in looking at the energy sector because all the talk of electric cars, we still have got what? We still have got everybody going to the gas station. And secondly, it has definitely been out of favor. And thirdly, we got this Aramco deal, and I'm not a conspiracy theorist, but I mean, they're trying to get maybe a $2 trillion offering sold, right? Maybe as early as next year or so. And if you're in an environment of $20 or $30 crude, and everyone's talking electric cars, you might have a hard time raising money for something like that. It might look like and feel like somebody who got into something is trying to dump it to the public in a declining environment, which is what it kind of looks like now anyway, because, with our shale and our production, it looks like that Saudi oil is not exactly as important as it used to be. So there might not be a line wrapped around the block trying to buy the Aramco deal unless they could get prices of oil into the 60s and 70s and 80s by next year. So that's something to keep an eye on, I think, as a, shall we say, a peripheral situation that could be happening as well. All right, so that was one that looked like it was trying to make some kind of a turn, possibly. Got to keep an eye on it. And then I'll give you another one here that is trying to make a turn. That's healthcare. Excuse me. And on healthcare, again, I'm using this for illustrative purposes only on these ETFs. 172 is the ETF on healthcare, and it's got moving averages of 172 and 170. So a little bit more strength here, and we could be looking at a sector that could be looking pretty good. And, some of these guys pay pretty good dividends, like Pfizer, PFE, and Bristol Myers Squibb at BMW. Also, some of the biotechs could be something that's something, and some of them have been beaten down, like Biogen, BIIB. And then, of course, you've always got the big horse going, Amgen. So, I'd keep a little bit of an eye on those and see if they can sustain themselves because, again, they're not coming off of the highs. The highs on some of those companies are pretty far away. And that's a sector, again, that I'm keeping an eye on a little bit here. Another one would be the financials. I mean, everybody's talking about those. We can talk a little bit about, and again, these guys are paying pretty good dividends. Wells Fargo, good dividend. Some of these, JP Morgan didn't pay a bad dividend. And so basically looking at, I will use XLF here. That's a pretty popular one as well. And we'll show you that XLF is at 2808. The low for the year has been 22, so it's been obviously matriculating to the upside. Had a pullback on Friday. Moving averages on that is at 27.5 and 26.5. So, we'll have to see if it can hold its water here. But at least with some of those stocks that I mentioned, Bank of America, Citigroup, all the majors, they are supposed to be, benefiting possibly in some of the financial situations that are coming up. The regional banks, KRE, they are, or it is, moving towards the upside a bit as well, but pulling back. One stock that I looked at of the smaller banks that I thought might be interesting, because as I was going through Florida, I saw they had pretty good presence down there, BBT. And BBT, as you can see, pays almost 3.5 or over 3 anyway, and it's been going it's not very far from its 52-week high, so it's had some pretty good momentum. So that's one of the better regionals, and their locations down there in some of the southern areas and the East Coast. That's a lot of money down there, so you would imagine they could do some business. Okay, so the next one would be industrials, and we did see a little bit of a comeback in some of those stocks, and that one's trading at, where are we at? 147. And you've got a moving average of 144 and 139. So again, these things are pulling back. And again, if we're going to go into the abyss here, obviously you'd like to, keep your powder dry. So if you see this VIX going 17, 18, 20 next week, then obviously you got to be careful. Again, this month of October, nobody's talking about it as if it's not important. I think it's the most important thing around. This China deal, who knows what's going to happen there? The evidence is nothing's going to happen, right? And if something does happen, you could probably imagine it's a watered down deal. As far as the Fed is concerned, they're not going to go to negative interest rates. So, how much more help you're going to get out of them. So you better get the earnings, right? And valuations, obviously, because the rates did go down, people are willing to pay a little bit more for a dollar of earnings, but that won't happen if the earnings dry up. Okay, so the bottom line is very important. Now the consumers out there spending, so you're going to probably have success stories, but you're going to have surprises. Obviously, the brick and mortar retailers like Nordstrom and those kind of guys, they're having a rough time because people want the best price they can possibly get, and that's where your Ross stores, TJ Maxx, and Target and those kind of guys, Walmart, that's why they're making out pretty good because, people are working, but they're not exactly, bringing home, buckets of cash. So they're still going to be pretty tight with the money. And it also costs a lot of money to live between utilities and your house payment and your kid wants to go to school and then here comes the car and everything else. So the bottom line is that there's plenty of bites on the apple when you bring money home. And ergo, that's, I think, why these discount retailers and online retailers, have been doing so well. Again, in the industrial sector here, it does seem like it's trying to make a turn. The moving averages are inverted and moving to the upside, but I'd still be a little bit careful on it. And again, keep an eye on it. But clearly, they're constructive. Next one after that is materials. And let's show you what the material sectors look like. Now, these are ones that I think are a little bit more towards starting their move as opposed to have been moving already. And here you go at 127 on the materials ETF with a moving averages at 125 and 122. Okay, so you're inverted to the upside, and so these things have had a good pop. Hey, listen, we've gone up pretty good here in the last month. August, did have some volatility on the downside, and September, people have covered their shorts, of course, because why? You broke above 29.40, which was pretty darn good resistance. So obviously, anybody who was shorting is covering at that point, and then the tough guys are waiting for new highs to get out, and there's a 50-50 chance that could happen as well. With regards to, so those are some of the sectors that are kind of turning and look like there could be something going on. And the ones that have already turned and have been trending higher are stuff like the REITs. The REIT that I was watching is at 93, and the moving averages are at 90 and 86. Another place people have been hiding is utilities, and the one that I'm watching is at 142 with the moving averages at 136 and 129. Consumer discretionary, the one that I'm watching. Well, let me put it up here so you can take a look. The consumer discretionaries, 180, and the moving averages are 180 and 172. And the staples are at 155, and you're looking at 153 and 145. Okay. Now, another one that seems to be pretty, this is one that I've been watching and talking about to people who are interested in newsy type companies, is the communications ETF, which is trading at 89 with moving averages at 88 and 84. Now, telephone, look at that dividend, over 5%. And I've been talking about this and following it and suggesting people take a bite on this thing if that's what they want to do, at 31 and 32 and 34, you see? And it's been going up. Now, this is only giving you a chart for how far? 3 months. No, we're talking about longer than that. Let's go year to date. This thing started getting above 30, and it was pretty reasonable to look that it might be keep going. And it pays a good dividend. Again, that's a heck of a dividend. So again, once you got above 30 and you see it held 30, that was a good deal. Get above 32, held 32, that's a good deal. Get above 34, that's a good deal. Now you're up here. Obviously, it would be nicer if we could have a pullback towards maybe some of this support, maybe fill that gap in. That might be a nice thing. And the volume is 79 million. Let's take a look at what the volume means as far as, is it huge volume or is it similar to what's been going on? Well, look, yeah, it's huge volume. Look at the volume averaging 34 million there. and 32 million there on a 50-day and a 200-day. And look how much we did today, 79 million. So people are buying into this thing. The Elliott company with this Paul Singer, I guess, took a pretty major position. And so, while 35 would be a lovely place to get in if it's going to still remain bullish, again, with that kind of dividend, it can bounce around all you want because you're getting paid very nicely for holding on to it. So that's one that you could keep an eye on in the communications sector because, again, they are talking about maybe doing something with DirecTV and doing something with some of their other properties to try to increase shareholder value. As far as tech is concerned, let's look at the semis. Because everybody's screaming, the semis are up, so the whole market's going to go up. Semis are up, so the whole market's going to go up. Let's see what's going on. Well, they're not going up so much right now. So here, this 123 area, I think is very serious, right? One there, one there, one there. And right now, you got a gap down here at 115. It closed obviously on the low, practically on the low. And the volume was 5 million on the SMH. Let's see what the volume is normally and see if this is a heavy volume sell-off or just a drop in the bucket. Volume's normally 5 million and 6 million, but see the volume's drying up a bit. You see 50-day volume, only 5 million average, 200-day volume, 6.6. So the volume's drying up while you're at high prices. Maybe that's not such a great thing. The volume yesterday was not that big. So again, this 120 neighborhood is going to be very big for this thing. And if it gives it up here, it's be like the third time. And so you have to be a little bit careful of the semis up here. Again, if it breaks above 120, obviously who knows where it could go because it'd be in rarefied air, right? New high territory. And this is the kind of sector that can go nuts when it gets going, as you can see. Went from 90 to 120 this year alone. Okay, let's tell you, some of you guys are into the big stocks, and I'll give you some feeling, my opinion, my observation on some of them. Okay, Apple Computer, again, they've got a new product out, and, that's the result of the new product coming out. So that's not that impressive. They tried to take it up, 222, right? And in the moment, 217. 233 has been the high and has been the high for quite a long time, right? So no new high, and then basically you're in the 217 area. Let's take a look at the chart, see if there's anything going on there. Well, you got a high point now to defend against, which is the recent 227 area, I think, something like that. And now, again, if it does roll over a bit, those would be the two spots if I was putting on any type of a hedge or any type of a negative position, a bearish position. I would be very careful of those two spots there. Because if you take out the 230, there are people who are talking that this is a $350 stock because this services business is going to go through the roof. And they got the Apple TV and these watches people are going around looking like Maxwell Smart, with their watch going. And so, this could be a company that it goes to 350 over time if these consumer products really hit the boards as well. But they are losing stuff over in China. They were one of the top companies over there, and they have lost some values, and they're arguing about trying to get a waiver on some of the tariffs and stuff like that, and some of the people are pushing back. So, there's more than these people have got a tremendous amount of cash on the sideline. They've borrowed a ton of cash at low interest, or what they perceive as very low interest. So the bottom line is that they've got plenty of liquidity if they want to buy their own stock. But they probably would like to, better than buy their own stock, get some new products and new iPhones going off the shelves and get those services business going. That's why they're trying to undercut everybody with Apple TV at $499. So, they're out there fighting, and, bad-mouthing Apple's like bad-mouthing Santa Claus. This has been a company that kept giving for a long time. So I would say that in the short run, until we take out 233, I don't think being cautious is a negative idea. And again, if you combine an earnings report that doesn't make people happy and sales of their new iPhone that they just are going out there with that make people unhappy, then there would be vulnerability on the stock with it not clearing the 230 mark, and then if the news turns at all. Okay, let's turn towards the next one that people watch a lot is Google. And, of course, they're in the news and not always so good. Them and Facebook. And they rolled over a little bit to the downside as well, I would say. It was at 243 on the high on Friday, and it went home at 229. And it's down 2.5 in the aftermarket. So let's take a look at if that shows us anything as well. Yeah, again, it goes up to this 1250 area, and it filled in the gap there. There was a gap, so that gap's done. So we don't have to worry about it going up to fill any gaps. And now, like I say, it is up at this 1250 area, and now it's trying to see if it can hold that area. So it looks like if it were to break under 1200, then it could be going back into the soup a little bit. You don't know how these investigations and inquiries go, and you don't know what type of pressure there is governmentally on these guys, not only in the U.S., but in Europe. Okay, the other one who seems to be under heat for this is Facebook. Let's see what that looks like. Again, this 1289, is the high. So, you went up to 1250. Well, for God's sakes, on a stock like this that goes up 100, $200 with no problems back and forth, being a little patient to see if you can take out that 1290 area might not be the worst thing in the world, because if there's no reason to take out these highs, you got to have better earnings. They may well have them, but you're going to have that, and you're going to have growth of revenue. And so if you have those things, maybe they can take out that 1300 mark. If not, then somebody's selling into these rallies, right? Somebody's selling into these rallies. This is probably not the public, right? So be careful when you see that kind of thing. And again, the hedging tactics that I talked about, if you have any questions on those, I'll give you my email at the end of the broadcast, and you could shoot me an email and I can talk to you directly. All right, Google, and what is the other ones up here? Microsoft. Now that one you can't say too much bad about. They got 40 billion, which is about 4% of the stock that they have in cash that they're going to buy stock with. But again, although this is the shining light, if in fact this 142 area and 143, people have been saying, is a little bit of a rough racket. So that's, if it starts breaking above 142, 150 looks like it could very well be in the cards. But if you were going to hedge, or you're going to do something defensive, using 142 as a line in the sand might make some sense. Now it just filled the gap, so nothing there. But if you start taking out 135, and for God's sake, if you took out 130, then you'd be darn happy you had some hedge going on up here. Okay, hedging means you're going to have to give up something to get something. Don't forget that. You can't get your cake and eat it too. In other words, there has to be a risk to the hedge. So make sure you understand it before you even participate it. Ask your clearing firm and your broker for clarity if you need it. All right. What else is going on out there? I didn't show you Netflix. And you can see that was under, remember I told you, is under big pressure, 23 million shares, $15 off. And again, when you get these big volume drops, sometimes they are followed by a little bit of a low volume pop back. But this one, I told you, it's only 30% off its high. So this could have some more real estate to make up in. And that is pretty much a give up phase, breaking that 280. So again, there has to be a buyer for every seller. So today, while all those people were selling, somebody did buy. And if it's market makers or smart money and there's no volume behind it, it could take a pop back up. But I would be worried that there's another leg down into the 240 area, and where those lows are for the year, 230, 240. It's possible with that kind of momentum. Now this gap up here, okay, over time, that could drag the market back up. Just like it did with Google. You saw Google was way down on that big gap, and then over time, it went back up and filled it. Same thing I think Boeing might be in the process of doing when they had the bad news that did a big gap. Let me show you that. But what you want to try to do is, again, if you're bullish and something breaks out on huge volume, well, if on the drop off of that, the volume dries up, again, it's a low volume sell-off, and that might be worthwhile to buy into at some point. Same thing if something sells off on big volume and then it rallies on lower volume, that might be something to do some selling into. Anyway, let's take a look at Boeing, and you can see what I'm talking about. Yeah, big gap here between 420 and 400, and it's in the process of trying to get back in there. Again, this is a two-horse race, right? Airbus and Boeing. So again, these guys are not going anywhere. And once they clean up this plane situation, which, everything gets cleaned up over time, it's a situation where it's probably a darn good company long run. But obviously this 380, 400 area could be some problems to get through, because you've tried it there, you've tried it up here, you tried it up here, and now you're trying up here. So again, in the short run here, had a big run from 320 to 380. That's a 60-buck run. And again, if it doesn't have any new juice to keep the engine going, it could back off a little bit. But do I think sometime in the future it'll fill in that gap? Absolutely. Why? Because again, they've got a semi-monopoly on the situation. Speaking of a two-horse race, let's look at Home Depot and Lowe's, because that's a two-horse race. Home Depot went to 235, and now it's at 224. It's probably like a lot of these strong blue chips, like Microsoft, et cetera. You know, they're great-looking companies. They're great-run companies. They got everything going for them, but the trees don't grow to the sky. And so in this particular case, you know, you have stopped at the 235 area, and now it's rolled over a bit, but nothing to write home about. You had a double top here at 220, so you'd certainly like to stop at 220 on the pullback, right? And you'd like to also, you got a big high volume, right? High volume breakout. And now if it pulls back and the volume is very low, that would be an indication that it could be a buying opportunity. You know, Jay Powell's not looking for a recession anytime soon. A lot of this inverted yield curve is very early as far as recessionary talk. 3.5 on the employment number. You know, people are out there working. People are out there buying things. You know, I think any major drops, there doesn't seem like that's in the cards. And again, the S&P cannot get underneath 2940 right now. So until that happens, and until these earnings come out in October, you know, we don't really know exactly where we're going. But I suspect we're probably in a trading range. And that trading range may be 2,700 to 3,100. And that trading range may last for quite a long time. Okay, let's take a look here. And Lowe's. Now, they tell me Lowe's has a better valuation. But yeah, it doesn't really look like that from the PE ratio. But again, these guys go hand in hand. You know, I mean, they're just the same chart pretty much. So if this thing is going to just have a tiny pullback, now look at that gap. You see? So I'd be concerned that something's going to happen to make that gap fill up. Just like you see this gap down, and look, it came up and filled the gap. So, you know, these gaps generally get filled, you know, at some point. So I'd be concerned with this kind of thing. And again, you had a big high volume blowout, and now you could have a very low volume pullback, and maybe somewhere in this 95 to 100 area, or somewhere around 100 if it filled there on a bad day. That might be a time to take a look at that one. Although, you know, as I go into the two stores, you know, it does seem like I like Home Depot better, but that's just my opinion. Okay, let's go over a few other things real quick on the bond market. Where are we here? We got 20 minutes, so we're going to go over some other stuff. Let's talk about TLT, okay? Okay, TLT is trying to make a rebound here because, again, there seems to be a situation where the Fed cut, obviously, and that people are concerned still about a weakening economy. Well, you know, realistically, the consumer is spending a lot. The inflation numbers actually are above 2% on some indexes. And so I don't see the inflation, I see the inflation increasing, not going down. And I see consumer spending being fine. So what's not so fine is manufacturing and capital spending. Now, let's take a wild guess why that would be. If you have some administration going around the world bugging everybody with a bunch of tariffs and causing a lot of kerfuffles regarding trade, do you think that people who are in manufacturing are going to feel comfortable when it's possible he could come on there and say, get out of China, all of you, right now? I mean, you know, that kind of comment and that kind of stuff would make me not want to put a lot of money into new manufacturing, right? All right, so that's number one. Number two is capital spending. I'm certainly going to be hesitant on doing a bunch of capital spending when we've got a trade situation that's extremely unknown, and yields are collapsing, and we do see an inverted yield curve at some times, not this week so much, but we've had it, and some of the ones are still inverted. So the bottom line is that the financial markets on the debt side are giving cause that there's going to be weakness down the road. Everyone knows we're late cycle. We've been in this thing for a long time. And you've got a very unstable trade picture. You add all that up, of course manufacturing and of course capital spending is going to be dodgy, right? So if you remove that from the picture, then those numbers could kick in pretty darn big. We already got the consumer who's 2/3 of the economy spending money. So that's why the growth in the world, and now stimulus, okay, we're talking about bringing QE back in. He said that. And we know that Lagarde coming in with the ECB may put in a stimulus package, maybe a fiscal one. And we know that Japan just can't wait to stimulate further, and the Chinese are doing the same thing. Well, they're not stimulating to make their economies go down, right? So if there's going to be a surprise on the upside, it's going to be, I think, on the GDP numbers and growth, and it's going to be on what? On inflation, because people are out there spending, and they're going to have to pass these tariffs off to somebody at some point, and it's going to be the consumer. So the bottom line is I don't think that bodes well for extremely low yielding and negative yielding instruments. We went from 5 trillion or so negative yields up to 16 trillion this year. So we've tripled the amount of negative yielding sovereign debt. To me, that's outrageous, because you know what? When you borrow money from people, that's a good thing, right? But sometimes they knock at your door and they want their money back. And if they see growth in Europe and Asia and in the US, they're going to want their money back. And when they all want their money back at the same time, you have what they call a liquidity problem. And that's what I think could happen down the road between triple B corporate junk bonds, which means if they get downgraded one level, they're junk. And once they're junk, all the people that own them, that have a disclosure document that says we won't buy junk, under triple B, they're going to have to sell those. And there's trillions of dollars and all that kind of stuff. And then, of course, you've got leveraged loans, which are short-term, speculative loans. And then you've got what? You've got the sovereign debt. I mean, we all have to admit the amount of debt in the world is just getting off the charts. And that means people are owed money. And when people are owed money, sometimes they ask for the money back, or they want to get out of the note. And if there's nobody on the other side, or not enough liquidity on the other side, you get weird things going on. I mean, you just had it happen where? In the short-term overnight market, where they had to come in with billions and billions of dollars, because between corporate taxes and the Treasury issuing tons of debt, we're going to be running way over $1 trillion deficit. And this is late cycle. So I think that these extremely low interest rates, unless they're just going to print unlimited money, I think there's a big jeopardy in there. And these guys that are going for long duration and getting 2% or 3% long duration, I think that there's risk in that they have not fully appreciated. That's just my view. If we go to negative interest rates, everybody buying these lousy rates now, they're going to make money. And that even the negative yielding rates in Deutschland, they make money, because if you're negative 10 basis points and you go to negative 50 basis points, that guy who bought those bonds made money. So that's the wacky world we live in now. I'm not much into wacky, so I'm not a big bull in the bond market at these lower rates. And I think that they have underestimated two things: possible GDP growth through stimulus and possible inflation numbers to change. All right. In that debt market, though, if I'm looking at putting money to work as far as debt, I like short-term instruments with low durations. And I like a little bit of the emerging markets, because if the stimulus does work and the dollar does drop, then these emerging markets should do fairly well. So a mixed bag of lower duration instruments and maybe a little bit of emerging market international would be what I'd be focused on if I'm trying to make some income. Okay. And of course, some of those dividend paying stocks wouldn't be terrible to take a look at either, possibly. All right, the U.S. dollar. The U.S. dollar is strong, and it's in a trading range. So I'm a broken record, because every time people ask me, I say the same thing. The high of the range is about 99. The low range is about 95. And what's it been doing? It's been staying right in the middle of those two numbers. For how long? For a long time. So if we can break out of that range, then there's something to talk about for the dollar. If we can break above this 99 and stay there, see, it peaked up, but that was it. So if we can stay above 99 and stay there, then the dollar could have a lot more strength coming its way. If we can break under 95, which is down here, probably even 96, you'll probably have a situation where that could also continue down as well, because it would probably be accompanied by a reason for the dollar to be dropping, because it's just not going to go from 98 to 95 for no reason. And once this kind of a sideways action here, breaks down, well, if you measure the width of that and you put it to the bottom, you could get a substantial drop down towards 90 or even lower. So keep an eye on that. If Brexit goes the right way, British pound will probably rebound. If what do you call it? If Lagarde comes in, does a stimulus package, and gets those economies off their back, then obviously you could get some appreciation in the euro. Those are two currencies right off the bat that are down and out, but may not last. Okay. Let's just see. And by the way, when you're looking at Europe, let's take a look at some of the ETFs. You got European ETF that's been moving a bit higher this year, from 35 towards 38. And the moving averages on this is Europe's ETF. 37, 36, so they're inverted to the upside. So, as long as we can hold water here and not fall apart, this thing has been trying to turn up. Clearly above 40 would be more of a confirmation that the turn has occurred. Right now, 35 is the base and 40 is the resistance. Obviously, if you really want to hold on to it for any length of time, maybe waiting for the breakout is not a bad idea. Okay, let's talk about crude oil, okay? Crude oil, again, as I said, we are looking at a gap up and then a pullback. There's other shoes to drop in that Middle East, and so, that's why I'm saying these energy stocks may have a future to them, because you're looking at a situation where we got some troops going over there and this and that, and they're really Ukrainians with their money. I heard that they can't get any money through the U.S. at all. So I don't know how that ends, but it might not end extremely well. You never know. But here's crude oil, and here's what I was thinking. Again, big volume. Look at that big volume breakout. Now you got a low volume pullback, right? So 55 is a number I'd keep an eye on, and 54. These numbers, 53. These numbers under here. And if you take out 50, again, something's going on, and it's very, very, I would say, very negative at that point. So you broke above 60. That's good. You're coming back down, and again, there's your gap. So somewhere between 54 and 55 area. If it does pull back, you'd like to see that hold, and if that happens, then it could open the door for 65, 70, or 75. And again, these guys at Aramco, they're trying to raise money for I read $2 trillion offering. And so, they're not going to do it the night before, to try to get energy prices higher. So, I just think something like that could be a situation as well. So again, on crude oil, Q4 could be a good quarter for it if it can stay above 60 and move above 65. And again, that could translate into a good time for the energy stocks. Conversely, you break under the numbers I mentioned, and then you might take all bets off. All right. Metals. People have made a lot of money this year in metals, but they're giving back some of it nowadays because gold has gone on a pullback. My base case on gold was breakout above 1350, you're in, and 1520 to 1580 is a sell zone. So far, that's been accurate. If we can close above 1600, I'll change the base case. If not, I'm still looking for consolidation and pullbacks to take us closer to the 200-day moving average and the 50-day moving average, which are substantially under the market. So let's just see some of the things that I watched, like GDX. Again, the story is beautiful for gold. They're trying to get the dollar down, right? The administration, the Fed wants inflation to go up, right? That's good for gold. And then you've got stimulus all around the world, and deficits going through the roof. This is all positive for gold. Cheap money, higher inflation, and a weaker dollar. That's the trifecta for gold. With regards to, let's take a look at see exactly right. See, we had the big rally, right, on big volume. And then we had the big pullback here, lower volume. And so if you're a believer the pullback's over, clearly you'd use 26 as your line in the sand, right? If you think it may go down to this gap, which I think is possible, then that might be the more beneficial place to start adding to a portfolio. Or if you are trying to participate for the first time, maybe a little bit here, a little bit here, a little bit there, that kind of thing. But longer term, I just told you the trifecta on gold, and looks like a pretty good situation. There's a more aggressive way to play, which is the junior miners at GDXJ. And again, They have made a bit of a turn here. So if you think the pullback's over, this 36 number is a decent line in the sand. And if you think that this gap at 32 will get filled, then that would be your second area where you might take a look. Okay. And silver, again, the gold to silver ratio. I mean, I've been in this thing for decades. It used to be 30, 40 to 1. 40 to 1, you make a move. 30 to 1, you make a move. Then it went up to 95 to 1. So things have changed. I don't know why that has happened. My guess is that the industrial uses for silver have changed, and ergo the demand for it has changed. And that's one of the reasons possibly why the disparity between the gold and the silver. Same thing with platinum. Platinum used to trade at a big premium to gold. Now it's at a discount of significant amount. And the only guess I can have is that the industrial use for platinum and silver has changed. But that doesn't mean the silver, can't get drug up with the gold, which has been happening. So let's take a look at the silver ETF and see what it tells you. All right, it's 1680 right now, and let's take a look here. Yeah, so you see the 16 area here on the pullback, and again, same story, huge volume on the upside, low volume pullback. If you think the pullback's over, 16 looks like a reasonable line in the sand, and then it did fill that gap there. So again, silver, it has not had quite the move the gold has had. So it may not have quite as much of a pullback as well. But again, those are some decent lines in the sand here, clearly are 15 and 16. And then the upside, you take out 18, and then you're off to the races if you can do that. So the metals, again, now I'm going to show you a couple of copper stocks because copper at the 250 level looks like the base. And if it gets above 3, I think it'll be going someplace. So something that people are not talking about is copper, and I'm going to talk about it right now. And I have been reading, and some of the things I read, which I can't guarantee are true, but, I've been reading that the Chinese have been picking up a lot of copper. I know they're making big moves in other continents like Africa and South America, so they may need the copper to do building over there. So who knows why they're doing it, but I've heard that there's some pickup in that action by the Chinese. Anyway, taking a look at this thing here, this is Freeport-McMoRan. And you can see that, if I go back, I'll give you an idea of what these companies used to go for. And there's some gold involved in Freeport-McMoRan as well, I believe, because they did some purchasing of a gold company back in a few years ago. Let me just, okay, give me this in real quick. Yeah, it used to be $60 stock back in around 2010. So, you're not, this is not a high price for this thing right now. But, they have their problems, and, there's no assurance it's going back to those numbers. But let's look at the moving averages and see if there's a line in the sand you could use as a, 10 obviously is a number that you want to, the 52-week lows. So you're not that far away from them. 858 on August 28th. The 200-day and the 50-day were above the 50, but not above the 200. So this is a little bit more of a show-me state possibly, but on a longer-term basis, there could be value here. And then there's another company that some people are keeping an eye on, SCCO. And that company is a copper company, and it is Southern Copper, and it pays a dividend. So you're holding on to it, and you're getting paid a dividend. PE ratio is not nosebleed. And so basically, that's what you look like on that basis. Let me see how far back this is taking me. 1 year. Okay. And the moving averages come in right around 35 as well. So this area around 34, 35 is kind of important to get above. So, if we can get above this 36 area and then above 40, this thing might brighten your day quite a bit. And obviously, the 52-week low of 29 is not that far away. And again, if you can hold on to it for a while, you're going to get paid a dividend. So that, or at least currently you are. I can't assure dividends. Dividends are not guaranteed money. But this one is paying a dividend right now. So, that's basically what I'm seeing in the metal sector. I think I made it pretty clear. Other commodities for people that are out there trading the commodities that I would keep an eye on would be obviously soybeans. They're dying to get the soybeans, Chinese to buy soybeans. And, Trump does want to get reelected, so I'm sure he would like to get some kind of a deal where the soybeans get a bid. Now, again, Beyond Meat and all of this stuff going on, and some people, they're what do you call it? They're using the soybeans in many different ways. Um, Not only the soybeans, but after you crush the soybean, there's a thing called soybean oil, and there could be some potential there. So soybean oil and soybeans would be two areas that you'd keep an eye on. They had big rallies here last week or so, but they ran into $9 beans and turned right around. But it does seem like there's a bid, and I think that $8 area is a pretty good area of line in the sand. But you're going to have to clear 9 and 950 for the thing to turn into something important. So again, above 950 would be very constructive, plus a China deal, and then the bean oil as a secondary product would be something to keep an eye on, and make your own decision after you look at the charts, the fundamentals, and that kind of thing. Also, sugar is turned up a little bit because of its alternative fuel status. When you start bombing here and there, people start talking about the alternative fuel market again. And again, sugar sometimes can get a bid from that. It's also coming off of a lower area. And then finally, the price of coffee has turned up a little bit, and that was coming off of a low area. So those are some of the ones that I've been watching to look to see if there could be a sustainable trend there. And I would tell you that if you looked into it, you might see something there you like, you might not. All right, well, we are coming to the top of the hour here. And obviously, we went through quite a bit of information. I've been doing this a very, very long time, so it doesn't take much for me to give you my views and my observations because A, I've been doing it for a long time, and B, I watch them every day. So bottom line is I hope you took some notes, and I hope that you can do your own research and figure out what, if anything, might be appropriate to your circumstances. I always do remind everybody that past performance is not necessarily indicative of future results, and that you should consult your brokerage firm and your broker, to discuss what might not be right for you. How can people get a hold of me? That's the main thing right now because we are shutting down. You simply send an email out, and you send an email to OptionProfessor. That's OptionProfessor @gmail.com. And your question could be something about what we talked about. It could be something that you are involved in and you would like some, views on, some opinion on, some observation on. Ultimately, you're going to be the architect of your own activities. But, if there's some information that could be helpful to you, then that would be great. Also, you might have questions on hedging. I went over the collar strategy, the replacement strategy, the hedging strategy using married puts. There's obviously a lot more to the story than the brief explanation that I just gave. So that might be a cause of a question. And just send your information over to OptionProfessor @gmail.com. You'll also be eligible to get a weekly update that I shoot out, and that's free of charge. So bottom line is there's a lot of information that I love to share that hopefully helps people when they're making their decisions. And again, the way I provide it is through the email, OptionProfessor@gmail.com. You guys have had a very long day. I was the last of the Mohegans, which I don't know if that's good or bad, but hopefully you guys learned a lot and it was beneficial. I enjoyed being here. Anka, I wanted to say thank you very much for inviting me, and hopefully down the road we can do this again. So I'm going to swing it back over to Anka.
Yeah. Thank you so much, Jim. It was a fantastic presentation, and you made some really great points at the end about soybeans, about copper, about some commodities. And again, these are valuable, guys. These are so valuable points. Jim has been doing them for so long, and we have been actually together. We have been presenting together at David's show, and I really appreciate your input on the markets. I just love it. So thank you so much, Jim, for taking the time and coming here to present in front of a really large audience today.
Well, thank you very much, Anka.
Yeah, thank you. Thank you. I hope to see you again very soon.
Sure, you bet.
Okay. Oh, okay. PC, indeed, great presentation. I'm telling you guys, we're trying to bring the best of the best here, and Jim is one of the best.